Maximum money, minimum effort. Does that sound good? What I just talked about was wealth. What's wealth? Wealth is when you receive money, you receive income from an asset. And here's the critical thing for wealth. It's in exchange for none of your time. My name is Paul Smith and I'd like to welcome you to this week's edition of Money Matters. And in this week's edition of Money Matters, I'm going to explain to you the simplest and quickest way to get maximum money for minimum effort in property. And in the world of property, I've been a property investor now since 1982. So that's 41 years. And of all the different property strategies I've looked at, the one where you get most money for least time on your part is commercial property. So what is commercial property? Well, it's shops, which is what most people seem to go straight to. But it's also offices and gyms and amusement parks and factories and warehouses. In fact, it's actually simpler to say what commercial property isn't. Commercial property isn't somebody's home. And that's it, really. If nobody lives there, if it's not residential, then it's commercial. So this property cost me £30,000. I've had it for years and years and years. And the previous tenants, fantastic people, they used it as an office for a film production company up in Scotland. When the previous tenant was leaving, I put it up for rent, for lease. This property, you can see here, this is called Heads of Terms. It's just a 3-page document. And this has been agreed between me and my commercial surveyor, a chap called Gregor, and the new occupants. When you do a residential tenancy, when you get a tenant move in, or family or something move in to live there, in most of the UK, they would sign up to an AST, an assured short hold tenancy. It'd be different in Scotland, but the principle is that they would be expected to stay there for 6 months, and then after that, they can decide to leave. The period for which you're sure of your money, if you're a landlord, if you're sure of your income stream, is quite short. Well, instead of 2, 3, 4, 5 months, with this particular property, I've got 5 years. And that actually is on the low side for most of my commercial property. I've got commercial properties that I've just relet for 10 years, for 20 years. I've even got one at 25 years. So imagine if you didn't have all the kerfuffle and the paperwork and the advertising and the expense and the legal bills of changing tenants every 6 to 12 months, which is not unusual in residential property. So there's lack of aggravation, number one, that saves you a load of time. Number two, almost all commercial tenancies are on what's called an FRI basis, full repairing and insuring basis. Now that means if something breaks, the tenant fixes it. You know, the classic, oh, the central heating's broken. Can you please send a plumber, Mr. Landlord or Mrs. Landlord? No, in the commercial sense, you're responsible, you fix it. And by the way, when you move out in 5 years' time, 10 years' time, whatever, you do something called a dilapidations report, dilapidation survey, which means if I just put in a brand new combi boiler or a brand new carpet or brand new anything when they moved in and they've worn it out or broken it, the tenant has got to put it back. Dilapidations is the technical term for it, as it was when they moved in. So think about that. 5, 10, 15-year tenancies. 0 maintenance cost because the tenant's got to do it. 0 aggravation because the tenant's not bothering you about maintenance. 0 insurance because the tenant's got to insure it. Tip, you insure it and then charge the tenant, or get your agent to do it and charge the tenant. Letting fees. Normally a residential letting agent would cost you 10 or 15%. Not if you write the commercial lease the right way, the tenant pays it. So your gross that you receive as income on a monthly basis as a residential landlord, you've normally got to take off maybe 25%, 10% for letting fees, 5% for voids, 10% for maintenance. So before you know it, you've lost 1/4 of your rent. With commercial, your gross is your net. That's it. Pretty much the only thing you're going to take off is finance costs. The critical thing that you want to know in terms of is that a good thing to buy or not is the demand and the likely rent. And the super critical thing is how do you value it? So valuation, so V, if you imagine a mathematical formula, value equals the rent divided by the investment yield. That's it. Couldn't be simpler. But, of course, you need to understand what the hell you're talking about. So the value, how much is it going to be worth? So do what I did, buy an empty office for £30,000, put a tenant in it, you can triple the value. You can't do that with a house, can you? You can't buy a house for £200,000 or £300,000. Do nothing to it, put a tenant in it, and it's suddenly worth £1 million. That's what's happened here. I bought it for 30,000, I've put a tenant in it, and it's now worth £100,000 because I've put a tenant in it. So in residential property, the value is in the brickwork. The value is in the alterations. In commercial property, no. The value is in the paperwork. You will add value with one of these, a pen. That's how you add value. You sign a new lease. You don't need to start knocking things down. See how easy it is? So you buy something empty, you put a tenant in it, you do some paperwork, you increase the value, and then you either enjoy the cash flow or you sell it. Here's how you value it. So the income, what I've agreed on this little office, is £5,500 a year. So my income value equals income, which is £5,500 a year, divided by the investment yield. Now, these new tenants coming in are very high quality tenants. They're in the property sector. Be inappropriate for me to start telling you who they are. I've given you the address and everything, so I don't want to tell you all about their business. But they get an investment yield, okay? Now, the better the quality of tenant, the lower the yield. So just let me explain that to you slowly. If you've got someone like, someone blue chip, someone very prestigious, like, I don't know, Rolls Royce or Tesco, or someone that's of very high quality as a business, and therefore they're very unlikely to go bust. As an investor, from an investment yield perspective, an investor would take a relatively low yield because they're very, very safe. To go the other way, if I let this property to someone that has come straight out of college, they're relatively inexperienced, and they're going to start up a dog grooming parlour for which they've got no experience. As an investor, if you're going to take that kind of risk, you want a much, much higher reward. You want a much higher investment yield. So for the same office with the same rent, £5,500, if it's someone rock solid, you'd maybe get an investment yield of 3-4%. If it's someone very risky, because they've never done it before and there's no demand and whatever, you might be expecting as high as 15%. So I just want to show you this final bit on my phone before we wrap up for today. So for this particular tenant, so there's the agreed rent, £5,500, which you can see on the heads of terms. And the investment yield, because these guys are good operators, is 5.5%. So if I divide 5,500 by 0.055, so that's the 5.5%, 0.055, that equals £100,000. Now think about that in residential terms. A typical residential property is worth £300,000. Well, I could buy 10 of these for that, couldn't I? £300,000 is 10 times 30. I paid £30,000 for this one. So I could have 10 offices in exchange for one standard house because I'm buying them empty and distressed and whatever. If I then just put good tenants into each of them and make them worth £100,000 each, suddenly my £300,000 of 10 offices becomes £1 million. Now this is generating real wealth through property. And if, for instance, you wanted to go and do that and you wanted to put 60-70% mortgages on your purchase price, you could buy £300,000 worth of offices for £100,000 that are suddenly worth £1 million. And it's stress-free. Because once that paperwork's done, which Gregor and the solicitor would do anyway, then you don't need to go and see them. You don't need to do any regular inspections. You're not going to get bothered for repairs. And if you did have 10 of those at £5,500 each, well, that's £55,000 a year. In exchange for, if you leveraged it, £100,000 of investment. So if you want to learn more about commercial property, my strongest suggestion to you is to come along to an event that I run. It's called Advanced Wealth Through Property. There'll be a link somewhere below. It costs money. It's about 500 quid to spend 2 days with us. And that's the kind of stuff that we talk about. We talk about pensions, commercial property, gearing, leverage, how to release equity, all of that stuff. As a reminder, my name is Paul Smith, Touchstone Education. If you haven't liked and subscribed to the channel, please do. And look forward to working with you at Wealth Through Property. You've been wonderful. I've been Paul. See you next time.